Joining us now is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, hello to you. Welcome to 2017 and welcome to a continuation of Trump's Twitter trade. Just guide us through what sort of yourself and some of your colleagues over there in the US are making of some of these increasing investment calls almost from the president-elect.
Yeah, I mean, I think it's really good for sentiment. It's good for social media, et cetera, but it's not going to change the evolving narrative. And I think the markets are starting to wake up to that, he may be able to cut these deals, give people tax incentives to stay in America, et cetera. However, his bigger campaign promises are really going to be hard to keep, or they're going to be really hard to institute right away. And I think the stock market took its eye off of monetary policy, took its eye off of economic data, and just was pinning everything on infrastructure changes, regulatory environment, taxes, trade, et cetera. So I think we've gone too far too fast, and we might have reached a near-term tipping point in the market.
But with that said, I mean, it's not going to be until possibly even the fourth quarter of 2017 that we will see sort of fiscal policy changes, if any. So I guess, I mean, calendar is certainly a factor in this, but I guess ultimately also efficacy. I mean, Twitter, 40 characters doesn't really lend itself a huge amount really when it comes then translating that into actual fiscal policy.
Yeah, exactly. And I think a lot of that's going to come out tomorrow with the FOMC minutes being published. I mean, if you recall, back in the middle of December, Janet Yellen's speech was fairly hawkish in my view, and the market just doesn't seem to realize that she implied that with full employment, there's really no need for fiscal changes or fiscal policy, as it were, or fiscal stimulus. Also, the fact that she changed the dot forecast from 2 rate hikes to 3, and if that's the case, I mean, the market needs to start thinking that maybe there'll be another rate hike the first quarter of this year. But obviously, the market's not looking at that right now. There seems to be a lot of complacency in the market, and also a lot of zealousness with regards to equities.
Well, Larry, also coming up, I mean, even prior to Donald Trump entering the White House, we do, in fact, have a slew of earnings reports coming through, particularly the banks. I mean, obviously, we're not likely to see sort of any real knock-on effect from some of the market moves that we did see in that latter stages of 2016. But are there any warning signs likely to come through in those numbers?
Yeah, there could be. Just starting off, if I could, I mean, people are still living in the market. They're investing off of like a third quarter GDP, which, by the way, was just revised up to 3.5%. However, fourth quarter GDP right now stands at about a 1.5% consensus with risk to the downside. So a lot of this other talk that's been going on that people have front and center, the other things, the data, the FOMC minutes, both of those things will start to matter to the market, and people will trade accordingly. I don't think it will change a whole lot, although we could see a retracement given the jubilation we saw over the last few weeks of the year.
So let's get a look at today's trade then. We are seeing positive moves, capped somewhat by those moves in the oil price, but the 3 major indexes all looking relatively positive. What are you making of today's trade, sort of from your position over there on the ground, Larry?
Yeah, like right now, I think it's shifting below the surface. I mean, I still think there's that rotation that began back in September out of growth into value. There seems to be a lot of value picking in the energy sector, the auto sector, et cetera. But with that in mind, there's also a lot of complacency. We're not necessarily seeing a lot of inflows or retail inflows into the market. However, if you look at the volatility index, if you look at the Citigroup Economic Surprise Index, everything is pretty complacent right now, and that worries me.
And Larry, I understand you're still watching bond yields very closely as we do head into this new year.
I'm sorry, can you repeat that?
Bond yields, my understanding is you're seeing these as a pretty key driver as we head into the new year.
Yes. Yeah, exactly. I think it really matters a lot. One thing I'm looking at is, the German 10-year Bund, that capped out at almost 40 basis points middle of December. And except for today, it's basically retraced quite a bit. In our market, keep in mind back in 2013 during the taper tantrum, 10-year yields went from 1.5% to 3%. And I think that could still happen today. We could see 3%, although we could actually absorb that much better because the jobs outlook is much better. Economic numbers are sturdier than they were back in 2013. But beyond 3%, then it's going to start to spell trouble, especially if it moves up as fast as it did in the fourth quarter of 2016.
Larry Shover, always a pleasure to speak with you. Thank you so much for your insights this morning.